everyone. I'm Keith Sprower, Chief Investment Officer here at Global Wealth Advisors, and this is the second quarter of 2025 outlook. Just a note from a market reference point, I'm taping this on the 11th of April 2025, and I want to begin by looking at the first quarter's performance, knowing that it's not going to have a lot of value given how quickly the markets are moving. Somewhere around mid-March, we saw the U.S. equity market start to really be thinking about the effects of fiscal policy, particularly the possible layoffs of government workers, and more specifically, the tariffs. The far right column is showing performance of the different asset classes for the first quarter. Commodities have done well, mostly because precious metals, gold in particular, have done very well. International equities have held in there, as has fixed income. Then you start to move into some of the affected asset classes, and you can see that large cap and small cap declined well into negative territory by the end of the quarter. There's a great deal of concern with the movements in the markets, and rightly so. We tend not to see this much volatility, particularly on the downside moves we've seen, unless there is a crisis. And we don't seem to be in a crisis. What we're seeing currently is not technology issues like we saw during the flash crash. It's not fraud like we saw with Madoff and others. And it's not a hedge fund using too much leverage and then unwinding the trades, causing a big market drop. The environment is what I would call a substantial policy approach error, meaning the policy of better trade terms for the U.S. is not a bad policy, but the approach being taken to get it done is upsetting investors. And they are extrapolating this into the future and building in a worst case scenario. And that worst case scenario would be economic stagflation, which is higher inflation with a slowing economy. One of the things that we do have on our side is history. And one of the reasons why it's important to stay in the market is that over time the markets tend to work their way back. They come back, but because adjustments are made by producers and consumers to the issues that are in front of them. News happens quickly, and it's assimilated into the markets quickly as well. It's very difficult to get in and out of the market with the right timing. The point of these charts and the two market notes that we put out recently is to really understand the importance of staying in the market, the importance of having some level of confidence in the system. You can see that after every big drawdown, the markets have worked their way back. Another key to getting through these times is having a diversified portfolio. The graph shown here goes through the end of the first quarter, and though it may be a bit difficult to read, it's showing performance for international equity, fixed income, and one of our liquid alternative solutions. And they've all had positive performance in the first quarter, while the S&P 500 and the NASDAQ benchmarks are showing negative. And even though the news is very focused on what one asset class may be doing, equities in particular, there are other solutions in the portfolios that were supporting performance and helping us. One of the longer-term benefits of a pullback like we've seen recently is that it resets valuations. There's been a lot of talk over the last 6 months to a year about how high equity valuations were, given U.S. large caps were up over 25% in 2023 and at 25% in 2024. When we look at the right-hand side of these two graphs showing the S&P 500 forward PEs on the left and on the right, the Mega Cap 8, which is basically the Mag 7, you can see that if the overall PE before this started was somewhere in the low 20s for the S&P 500 and maybe in the high 20s for the Mag 8, those numbers have dropped to a much lower forward-looking average, something a lot closer to historical trends. So we certainly feel that we're in a place now where the market has built in some future uncertainty, and we can start from a level that's more realistic. One of the items that is still very positive is the fact that what is considered hard economic data hasn't been affected yet by what's going on with policy. As you can see from both of these graphs, the Fed favored inflation gauge on the left, the PCE, and unemployment on the right, they've increased a little bit, but are not out of expected ranges. The long-term goal for inflation gets the number down to about 2%, showing here at 2.8, and the unemployment trends at 4.2, which is exactly where it is today. This could certainly change going forward if tariff agreements aren't made, but keep in mind the economy was in a very good place coming into this. The soft economic data is another story. And what we're looking at here are consumer sentiment, which is how consumers feel about the world and what's going on right now. And on the right, the New York Fed does a survey for business leaders in the New York, New Jersey, and Connecticut region for what they're seeing in activity. And you can see that both of these graphs have had a significant decline. And it may not mean as much as the hard data, but it can lead us to draw a conclusion that people may be slowing spending, companies may be slowing hiring, and we can see an overall slowdown because of this retrenchment of businesses and consumers. These two graphs are always interesting to me because they give a breakdown generationally of household net worth on the left and participation in the markets via equities and mutual funds on the right. And you can see that in both cases, the biggest group in blue are the baby boomers. The baby boomers were born between 1946 and 1964, which puts them in their early 60s to late 70s in age, and they've been very important to the economy in recent years. They've done very well from themselves, particularly compared to generations after them. They saved a great deal of money, and even though they are close to or in retirement, they have not been hesitant to spend their savings. The markets have helped their assets grow, and it's allowed them to continue to spend on themselves and their families, which has in turn supported the economy. Now, just from a human nature psychology standpoint, when you see your assets or a particular group of your assets drop 15 to 20%, that starts to make you worry about if you're going to have enough. It may cause you to look at your spending in a different way, and that's something that we're keeping an eye on. The last slide I want to touch on before getting to the headwinds and tailwinds has to do with something that I talk about regularly, and that's the difference between what the market is pricing in for the Federal Reserve moves and what turns out to be the reality of the Fed moves. If you recall, the bigger the gap in the projected moves to actual moves, the greater the volatility to get the markets back in line. Looking at this chart, which we've seen before, it's showing us where the markets are predicting via the futures markets that the Fed will have moved over the course of the year up to and including their last meeting of this year, which is December 10th. Currently, the target Fed funds rate is 4.25 to 4.5. So looking at this as an example, if you see in the middle of the chart, there's a 33.6% chance the Fed will cut down to 3.5 to 3.75 by the end of the year, which is a 75 basis point move from where we are today. And the key to me is the fact that they're only pricing in a 1% chance that the Fed won't do anything, but overall is expecting 4 cuts totaling 1%, moving lower in the Fed funds rate. At the moment, everything the Fed is saying is that they're really going to watch and wait to see how policy plays out before jumping in. But an important key is that they are willing to jump in, and they still feel that more cuts may be needed. So where does that leave us over the next few quarters with what's moving against the market and what's helping move the markets forward? And I was putting pen to paper to make adjustments from the last quarter's outlook. There's a lot more headwinds than there are tailwinds. I continue to see the biggest headwind for the short and intermediate term as the unpredictability of policy and policy approach errors. Again, the policy may be good, the approach to putting it in place may not be. This has been evident over the past month or so, where we have moved to a spiraling from optimism on both sides on getting negotiations completed to frustration, which moves to combativeness. The other thing that's key is that it seems that we're in an environment where economic data is almost irrelevant compared to any day where there's talk of big fiscal policy changes. It didn't take long after the 90-day pause on some countries' tariffs for the White House to focus on what's becoming a one-on-one trade war with China. There are a lot of benefits to the USA from better trade policies with China, but the idea that in the short term, the U.S. can function successfully by decoupling from China is difficult to believe. So trade tensions and decoupling doesn't seem to be a great short-term plan. Our economies have been intertwined with imports and exports for decades. There always seems to be the occasional saber rattling, but complete cutoff in a short period of time is not going to bode well for either the economy or the markets. Things take time, and we rely on many countries for electronics and robotics that will need to bring manufacturing back to the U.S. And this brings me to the next bullet point, which is something we've touched on in the past and will touch on again. I'm sure that the fact that we've moved away from a bipolar geopolitical world of two superpowers like the Soviet Union and the U.S. to a unipolar world where it's just the U.S. as a superpower, like we saw when the Berlin Wall fell in '89, to the post-financial crisis, to the current geopolitical landscape, which is a multipolar world. And the countries in this group are the BRICS countries: Brazil, Russia, India, China, South Africa, and over the past 6 months or so, they've added Egypt, Ethiopia, Iran, the UAE, and Indonesia. This group is not waiting for permission to move forward from any superpower. They're trading with each other regardless of sanctions. They're strengthening those relationships. They're discussing getting rid of the US dollar as their reserve currency. And all you have to do is Google the Belt Road Initiative in China to see how far along they are. These changes over time are natural, but here in the US, it's probably not going to bode well. The last bullet point here is one that's been forgotten over the past couple of weeks, and that's the AI story. Companies are really going to have to adjust here, what it's going to mean for their productivity, what it's going to mean for their labor force, how much they're going to have to spend on CapEx to implement could move the markets. On the tailwind side, there are a few things that are helping. As I mentioned earlier, we're in a much better starting place with valuations. We're pricing in more uncertainty than we have in the past year or so. There's a softer regulatory environment. Deregulation is on the way. Tax cuts should be extended, which is expected at this point. We have discussed the fact that the economic data is not falling off a cliff yet. Negotiations could be ongoing, and we could see a much better situation with negotiations over the next 90 days. And the tariffs, they could lead us to some inflation, but maybe it's not a spike up in inflation that we saw during COVID. Historically, you get a little bit of inflation from tariffs. Then, as we discussed before, consumers, producers adjust, and that inflation could be short-lived. A lot of what's going on in the economy and in the markets is out of our control. We do know we don't want to jump out and go into cash for big chunks of the portfolio, but we have actively de-risked. And over time, we'll be looking for opportunities to take on risk and undervalue assets that we feel will benefit the portfolio performance and align with clients' long-term goals. To see more content from GWA, please consider subscribing to our social media listed here. From everyone here at Global Wealth Advisors, we appreciate your business and your trust. I'm Keith Sprower, and I'll speak with you next quarter.